Have you ever wondered what trading strategy do institutional traders at Wall Street use? Unlike retail traders, institutional traders have a proven track record of making hundreds of millions of dollars because they understand something that your average retail trader does not. We've spoken to Jason Sen, who shares his 40 years of experience working as a day trader, mentor, and technical analyst, so you can know what it's like to be on the floors of London Financial Exchange in just a few minutes. First and foremost, Wall Street traders typically do not use the same trading tools as retail traders. An example of this is candlestick charts. While an institutional trader may use it periodically, they mostly use other tools such as order flow footprint and depth of market. One advantage that these tools have over candlestick charts is that they are more specific and they showcase the volume traded by buyers and sellers. This allows traders to see the distribution of their trading activity more broadly, unlike using candlestick charts. Another tool that Wall Street traders like to use is the volume trading indicator, which is something that every retail trader has access to. This can be very useful if you use it as a confluence in your trading strategy to find out how strong or weak the movement is. It's quite easy to use. During periods of high volume, the spikes will be high, and with periods of low volume, the spikes will be lower. In terms of access to information, institutional traders like to use Bloomberg Terminal, which could be quite expensive for the average trader, but it's incredibly helpful because it gives you all the relevant trading information and news in one place. Now, when it comes to trading strategy, there's a number of them that Wall Street investors like to use, so pay close attention. Institutional traders like to use pairs trading to hedge against the markets. They do this by using two pairs that are correlated by selling one while buying the other. This ensures that they are not over-risking in one trade, which also helps them diversify their investments. Another strategy that traders at Wall Street like to use is what is called the event-driven trading. If you've seen my last video, you know that Wall Street traders pay close attention to economic, political, and financial events. By staying on the lookout 24/5, they're constantly aware of what's going on in the markets so that they can capitalize on the short-term burst of volume. They also take calculated bets on how they believe a stock or another instrument will respond to new regulations or policy changes. And just like retail traders, they use a stop loss or hedge their position to minimize the risk. One thing you'll see every successful trader do is that they follow a risk management strategy and have a portfolio diversification protocol. Regardless of the trading strategy employed, risk management is at the forefront of trading because it ensures profitability or at least a small manageable loss. Every trader at Wall Street calculates the risk amount before entering a trade and considers other factors to determine whether or not the risk is reasonable and what is the likelihood of them being profitable in the long term. This might surprise you, but unlike retail traders, Wall Street traders typically don't care about winning every trade. What they do care about is having their winning trades much larger than their losing trades. I hope you've been taking notes. Moving on to psychology, which is one thing you can start implementing right after watching this video. Wall Street traders embrace their losses by understanding it is a part of trading. Matter of fact, they use the data collected, even if it comes from losses, to analyze what went wrong. For example, using my data, I notice that my trades go to 60 to 70% of an average drawdown before I go into profit. This lets me know that I should adjust my entry position so I can maximize my profits. Going back to Wall Street traders, whether they're in loss or in profit, they stay detached from the outcome because they understand that this will negatively impact their trading, and this will also create a bias for their future trades. So they practice the art of keeping their emotions in control, even when it's difficult to do so. You see, institutional traders are not only prepared for losses from a financial perspective, but they're also prepared for losses from a mental perspective. I mean, imagine if a Wall Street trader doesn't show up to work the next morning because yesterday's trade went wrong. Wouldn't that be funny? And this is where the difference is noticeable. You see, most retail traders let their losses run in hopes that they will come back and go into profit. Meanwhile, institutional traders do the opposite. They cut their losses short and move on. And the same goes for winning trades. Most retail investors leave their profitable positions way too early. Meanwhile, institutional traders add more to that position and let it run for as long as possible. And for our final point, let's talk about capital. Without a doubt, the biggest advantage of being a Wall Street trader is access to capital, because they can employ more sophisticated trading strategies and handle market fluctuations more effectively. I mean, surely making 2% on a $500,000 trade is way different from making 2% on a $5,000 trade. You see what I mean? And that's why most traders purchase funded accounts to get access to more capital. Instead of putting $500 into a trading account, you can use that $500 to get access to a $100,000 funded account if you pass the prop firm's challenge. If this sounds like something you'd be interested, check out Propvator.com, which is the only platform to offer discounts and exclusive cashback on prop firm accounts. Thanks for watching and have a good day.